webinar is hosted by the Core Hub, which is the UK's national research hub responsible for carrying out multidisciplinary research on greenhouse gas removals, as well as for coordinating across the GGR demonstrator program. My name is Caterina Brandmayr. I'm the Director of Policy and Translation at the Grantham Institute at Imperial College, and I'm part of the team leading on the stakeholder engagement activities of the Core Hub. And it is my pleasure to chair this webinar, which is the first in our series of webinars, GGR Insights, aimed at presenting the latest research carried out by Core and debating what is needed to enable the sustainable scale-up of greenhouse gas removals in the UK. In today's session, we'll be taking a closer look at what are some of the key factors that can help unlock investment in GGR, noting that if the UK is to meet its net zero targets, greenhouse gas removals will need to be scaled up significantly over the coming decades, starting from a nearly non-existent baseline, and that this will require mobilizing tens of billions in private capital in this nascent sector, which therefore really puts the spotlight on the need to carefully consider what are the signals and incentives that are put in place if we are to effectively unlock this scale of investment. To explore this issue, I'm delighted to be joined by a brilliant panel of experts. First up are two members of the Core Hub team. Dr. Aoife Brophy is a lecturer in innovation and enterprise at the University of Oxford and leads the research on business models for Core. Aoife will introduce and provide some of the context to this research before handing over to Dr. Mark Workman, an affiliate researcher at Imperial, who leads the business and industry engagement for Core. Mark will provide an overview of the research on business, discuss some of the research on business models, their investment performance, and the different policy support scenarios and their implications for attracting private investment. And after that, we will hear from two further speakers. Hans Westerhof, co-founder and managing director of Remove, a carbon removal accelerator, and Dr. Chris Manson-Whitton, CEO of Progressive Energy, who will provide an investment and industry perspective on scaling up greenhouse gas removals. Before I hand over to Aoife, I should say there will also be some time for questions, given now that we've started a bit later than expected. But we are very keen to hear from you, so please do post your questions in the Q&A function and upvote questions as they appear, and we'll come back to those after the speaker's opening remarks. And with that, I shall hand over to Aoife for her opening remarks. Aoife, over to you.
Fantastic. Thank you so much, Caterina. And I will keep my opening remarks quite brief so that we can give space for Mark to go into more details. My job is really to set the scene before we go through some details of our recent work related to financing greenhouse gas removal technologies. And our team, as Caterina mentioned, I lead the business model work stream in the Core Hub. Our team takes a very broad view of business models, and really we're interested in understanding how to scale a range of technologies in ways that create economic, social, and environmental value. And that's a very complex undertaking, as we all know. Business models are really critical for the companies behind the scaling of these technologies to be able to attract investment. So that's our core assumption and why we're so interested in looking at business models. So for example, it's really important for companies to be clear on how revenues will be generated in the future, what kinds of risks there are to those revenues, what partners are required to be able to create different types of value. And so a business model lens really helps us to think ahead and to identify any challenges that might arise now in the near term or in the long-term future that might affect the ability of the industry as a whole to scale. And so due to the nature of uncertainty and complexity facing the nascent GGR industry, Mark will go into a lot more details on what we mean by this, uncertainty and complexity. Our work has been exploratory in nature by design. We've done a lot of interviews with investors and entrepreneurs in the UK and the US. And more recently, we've been convening different stakeholders, including investors, policymakers, entrepreneurs, project developers, to unpack the kinds of interventions that might be required to address some of the key challenges that these stakeholders are already experiencing and observing, and how they think things are going to evolve in the future. So for example, in some of our recent convenings, one of the key themes across participants has been the need to clarify who pays for the carbon dioxide greenhouse gas removals and how. And without being able to make progress on this fundamental question in setting up a new industry and a new market, it will be really difficult to build investor confidence in business models across a range of different technologies, and that's really critical to scaling the industry. So our key message today in brief is that the uncertainty and the complexity that are shaping the emergence of this new industry, this uncertainty and complexity calls for new approaches to developing and iterating policy interventions over time. And that's really important to be able to attract private capital. What do we mean by new approaches? We mean participatory processes that allow for the co-creation of interventions. These are likely to be more robust given the nature of uncertainty and complexity, and to integrate diverse knowledge, and knowledge that no single actor is able to provide on their own. We mean expanding how we think about policy interventions, not applying directly experience from other industries without taking into account the key characteristics that really set greenhouse gas removals apart. And we mean openness to considering new models for public-private collaboration as part of a suite of policy interventions to be able to manage risk and uncertainty. And Mark is going to go into some of the details of what we mean by this, and I'm going to hand over to him now to take us through an example from our recent work. Thank you.
That's great. Thanks very much, Aoife. I'm just going to share my screen, and hopefully everyone can now see that going forward. So here goes. So first of all, thank you very much, Aoife. That teases up very nicely. In terms of the people that were involved in the work that I'm just presenting right now, it's worth just giving a nod that we had a lot of help in the team. So the team's led by Aoife, supported by Asta and myself, but we also had members from the master's course and externals as well to deliver this work. So just highlighting that. In terms of the three key messages that we're going to sort of set the canvas for this panel session, there are three main ones that we're going to justify within the rest of the 10 or so minutes or 15 minutes that I've got on the presentation. The first is that the GGR sector has a number of complexity characteristics that make it incredibly hard to price private capital and therefore attract private sector investments. We've also done a diagnostic using an exploratory approach, which strongly indicates that any policy intervention, the two policy interventions that have been aired or have been considered by the UK government, and the UK government is a lot more progressive than many governments in this space, will likely be insufficient to crowd in risk-adjusted capital, i.e. off-balance sheet private finance. The EU ETS and the introduction of the carbon contract of difference will be insufficient, we assess, to attract private capital into the space. Why is this very important? This is fundamental because the source of capital for GGR has tended to be concessionary capital, which is limited, and that's of the order of billions. The government obviously cannot continue to underwrite that as a function of fiscal constraints, or is unlikely to be able to. And therefore, there is a need to therefore get risk-adjusted capital, which will allow both off-balance sheet capital to be raised, therefore allowing startups to be able to operate more effectively, and also allow broader access to other sources of patient capital, private equity, pension funds, and so on. And the final point is that in the absence of a mandated demand for greenhouse gas removal, it means that risk-sharing interventions are needed to reduce the uncertainty for greenhouse gas business ventures and therefore put them in a position to be able to attract capital. And we've got a great example here in terms of what Chris and the progressive team have done at HyNet in terms of their industrial ecology approach. And what we're going to explore in the rest of this talk is essentially how public-private collaborations can actually be developed within the space going forward. So in terms of the first point that we like to raise, we need to consider the complexity characteristics. The complexity characteristics of the sector are far more high-dimensional than that for the rollout of solar and offshore wind, and indeed onshore wind. The greenhouse gas removal sector is technologically highly heterogeneous. It is a function of that, the information asymmetries and the uncertainty with which how the sector will develop are very highly uncertain. We're also talking about a political economy being developed because we need to move so fast in order to roll out the sector that there are incumbents almost certainly need to be involved, and where there's large infrastructure requirements, you're almost certainly going to engage with public acceptance of this technology is largely untested. There is a lack of analysis of the role of strategic investment in order to inform government policy in this, though they've made massive steps with the Track 1 and Track 2 initiatives. Then there's the point that Aoife raised very strongly with regards to market-led complexity. There is this lingering question as to who is going to pay for the negative emission sectors and how. And until that's underpinned, this complexity will maintain its presence with regard to income in hindering the ability for private capital to come in. There is also the issue that innovation is taking place right at the frontier of the space, and Chris might allude to that in his segue later. And in essence, what you've got is you've got policymakers and regulators, market frameworks being retrofitted into the space in order to make sure that the sector can actually be backstopped in order to build going forward. And then to make this slightly harder for the policymakers and regulators, there's actually very limited systemic visibility of the research project activities in investment programs. Having said that, the government has done an amazing job in engaging with the sector, but still there is a need for a broader systemic perspective of this, which is very hard to achieve. So what are the concerns with regards to the adoption of analytical processes to which the offshore wind, onshore wind, and the solar sector was assessed? Essentially, they tended to apply sort of consolidative approaches, which tend to really struggle with a lot of the complexity that I've just highlighted earlier. They tend to play to very neoclassic constructs, whereby the role of the firm is over-assessed as a function of they assume that foresight is perfect and that resource allocation within the economy is highly efficient, i.e. old markets are destroyed, new ones are created, and the resources that were supporting the old markets will miraculously be reallocated to the new sector. And so what the team has applied is a deep uncertainty approach, and I'll unpack a bit of that going forward. And the key thing that we need to highlight is that consolidative approaches aren't useless. It's just that they really struggle with the complexity, and they're likely to highlight an upper bound as to what policy interventions will bring. In terms of how they struggle to pick up elements of complexity within the real economy, they struggle with path dependence. There are issues with regards planning regulation and employment regulation, and more importantly, skills, i.e. that of economic reallocation, they very much struggle to handle. And there are huge incumbency effects with regard to non-financial transaction costs to generate virtuous and viable CDR value chains, which very much plays to Aoife's point about the need for new collaborative spaces in order to co-generate and better understand the needs of the sector going forward and the actors participating. So I'm going to skim over this in the interest of time. Essentially, I just want to get across the fact that exploratory approaches tend to not predict the future, which tends to be what happens when you do orthodox approaches that are used for solar and wind power. And you tend to develop systems which allow you to very much unpack the uncertainty space. So if you see my arrow here, you can't see my arrow. On the bottom chart, you've basically got an exploratory approach which unpacks the uncertainty within a portfolio according to a number of metrics. And then what you see is that you pick up a lot more uncertainty by using exploratory approaches. Whereas if you look at the top chart, you've got essentially a chart showing what the rollout of net zero would be required for the 2050 targets, which kind of hides the uncertainty. So it's just very important to highlight that going forward. So in terms of assessing semi-quantitatively what the policy interventions and whether or not they will seek to attract private capital, this came from an assessment that the team did, a qualitative assessment regarding some benchmarking around the offshore wind sector. And the offshore wind sector is a nice benchmark because in about 25 years, the UK government has done a fantastic job in terms of establishing a sector that was nascent in effectively 2000, and then they generated a sector on the scale of tens of gigawatts, particularly offshore, and they managed to achieve in 25 years what we're likely to need to achieve in order to establish something similar of scale within the greenhouse gas removal sector. And it's attracted enormous amounts of investment, lots of jobs. And it's worth highlighting that that effectively what they did in the offshore wind sector is they developed a number of interim policies that take you from concessionary capital to the contracts for difference. And that highlighted in blue is effectively what we're missing out on in the greenhouse gas removal sector. So there was a lot of confidence building, there were interim policies, and yet we seem to be going within the greenhouse gas removal sector, this 30-year jump. So what we effectively did in order to do this analysis is that we took 5 value chains, and then which were direct air capture, bioenergy carbon capture for electricity, and BECCS for hydrogen, enhanced rock weathering, and biochar. And then we turned them into these business models as curated at the bottom there. And then what we then did is that we used, we then turned those business models, and this is a business model for a biomass plant. We turned that into a financially discounted cash flow analysis as per this transition here. What we then did is, based on a number of interviews, we did about 50 interviews all told. I think the team's probably done over 100 in this. We then, from the left to right, in terms of the quantitative part, we did the 15-year discounted cash flow model. We then run different policy scenarios through that, and then we produced a vulnerability analysis. We basically highlighted all the uncertainty as per the lower graph that I showed earlier on in the presentation. And that basically results in this exploratory approach, and we generated over 2,000 scenarios, unpacking a number of uncertainties around CapEx, the rate at which a business can scale, the ability to generate revenue, and policy uncertainties. And in terms of the assessment regarding the different possible futures, we essentially assessed a baseline where there was no policy support. And if you look at that, we assessed the ability for the business model to attract financial capital by different bands of the internal rate of return. So for strategic investors, we stated that they needed to attain a 12% IRR. For infrastructure investors, the funds, it was 12 to 15. For private equity, it needed to be 20%. And you can see that with no policy support, you effectively get very few business models being able to attract private capital. Only 33% of possible futures results in BECCS actually crossing the IRR threshold for strategic investors. And then when we did the second baseline, which was the CFD and the inclusion of CDR into the UK ETS, though you got better performance for BECCS power, it's highlighting that these aren't probabilistic functions, these are possibilistic. In 54% of futures, we managed to get the IRR to something that was that would attract private capital going forward. But in essence, a lot of the performances across these futures to attract private capital, we really struggled to be able to see that private capital would be attracted as a function not crossing that those IRR thresholds. So that's just highlighting that going forward. In terms of the third point that we'd like to make in the closing part of this presentation, in essence, in the absence of mandated demand for greenhouse gas removal, it just means that the risk is too great. So how can we actually address that risk? And that's something that this research explored. And we considered 4 different interventions, essentially interventions around the storage obligation, and then 4 different forms of public-private collaboration in order to see whether or not they would actually be able to get the IRR to cross those thresholds to attract private capital going forward. And so what we found is that when you introduce a tax storage credit or a joint venture in terms of a purchasing private partnership, public-private partnership, or a build, operate, and transfer, and I can tell you what these different things are later, but in the interest of time, I won't do that right now. You find that you get far greater a number of the business models being able to achieve in possible futures the ability to cross those thresholds going forward. And therefore, we're advocating, again, what Aoife was saying at the beginning, the need to generate these public-private collaborations going forward. And in terms of showing the high fidelity with which you can assess the different forms of interventions, This is essentially the BECCS power plant, BECCS power business model, whereby you have a high number of futures whereby strategic investors are actually willing to invest. What you can then also find out is you can actually work out very targeted policy interventions that are needed to address the ability for the sector to develop. So you've got these 5 different assessments. You've got financial assessments for the performance of the BECCS power business model under the public-private partnership. And what you find is that the carbon abatement cost, which is essentially the lifetime of the asset over the amount of carbon that's actually sucked out of the atmosphere by over the lifetime of the asset divided by the actual cost. What you tend to find is that there's an inverse relationship between the carbon abatement cost and the discounted payback, which basically mean that actors will tend to go for business models unless regulation is put into place, whereby they will seek to get a quicker return rather than actually optimize the plant's ability to obtain a carbon abatement. So summary is very simple. We believe that from this analysis that we've undertaken is that the government policies that are very important, but on their own will be insufficient to actually attract private capital, that we consider that public-private collaborations would be more effective in some way. Public-private collaborations for the next phase would allow governments to guide the sector whilst also providing a backstop to risk for private partners. And ultimately, if we can get the private capital and risk-adjusted capital in for the 5 and the 23 million tonne interim targets that have been notionally set, it will ultimately reduce the cost to attaining net zero more broadly going forward. And again, I don't have time to go into this, but again, the high fidelity process by which the team applied means that you can actually zero in according to the discounted cash flow the different forms of interventions and public-private partnerships that allow the business models to be able to cross those IRR thresholds. And in terms of resonating with regards to public-private partnerships, collaborations rather, the UK, it's slightly, it would be great to find out more why this isn't being considered within the UK, seeing as we have a rich history of public-private collaborations in the past. For example, the Energy Technologies Institute, the Aerospace Technologies Institute, which presently runs in the Faraday Institute. That concludes the talk. I can work out how to go off. I'll hand over.
Great, thanks a lot, Mark. Before I hand over to Hans for his response, just a brief reminder to please post your questions in the Q&A function. I see that there's already one question there, but please keep feeding those in, and we'll come to those after Hans and Chris have spoken. Hans, over to you.
Thank you, Caterina. At Remove, we support CDR startups in Europe, in India, and in sub-Saharan Africa. And we recently published a report about business models that CDR startups employ and investor perspectives on the CDR landscape based on dozens of interviews. And thank you for the opportunity to share some results and observations from the trenches of CDR startups trying to get to market on a daily basis. First and foremost, and it has been mentioned, CDR is small and emerging, and so is the investment landscape. It is not at all specialized yet, and we do see that there are as many perspectives that investors employ as there are funds. However, one conclusion does get supported. If CDR is new and emerging, it cannot be big yet, and relying on the voluntary carbon market for CDR businesses in order to achieve success seems like a bet that not many investors support. And they are right if you look at the numbers. If you look at, for example, the State of CDR report or CDR.FYI, the voluntary carbon market currently is an avoidance and reduction market, not a durable removal market. And novel tech removal is a very low single-digit percentage. In 23, we had over 4 million tons of durable CDR sold. In 24, over 8. Cumulatively, by now we are at 26 million tons, it sounds like a nice number, but it's actually very small. And if you then take out the largest projects, which are BECCS, 4 BECCS projects, and you take out Microsoft, then 20 million out of those 26 million tons are accounted for. So there's very little that remains. So the first conclusion is that although we as a world might need removal at a gigaton scale, most investors do not believe that voluntary will get us there. And looking at the numbers, they are right. Certainly within the time frames they have to work with. And moreover, they do not rely on compliance or regulation for their investments to become successful. When asked, they are all aware of discussions and possible future developments. They would, of course, favor it, but certainly they do not rely on it. So if it comes to that, it would be a welcome tailwind, but currently their investments should be sound in their own right, without banking on possible future beneficial policies coming into place. Then what about the high prices that we sometimes see in the CDR market? And here again, it's easy to misconceive prices like $800 per ton to see as expressions of value, because they are not. They should be seen as corporate subsidies made by a few trailblazing buyers. And prices are coming down already from 23 to 24, usually over 20% with the exception of biochar. Moreover, when asked around green premiums, we see varying answers, but the general take is that nobody relies on green premiums at scale. And some investors see a role in the early days temporarily, but green premiums cannot be a pillar under business models. And startups face the same situation. The number one question that we get from startups is get me to buyers, get me at the table of buyers, get me buyer introductions. But given the situations, what do we see startups and investors do? Startups diversify business models, and investors confronted with tech risk and market risk try to at least reduce one of those two risks by moving investments away from the VCM. What this means in practice, and what we see startups do, is DAC units coupled with HVAC systems, bringing down energy costs of buildings, a clear and straightforward value proposition. Using CO2 to make cementitious materials with higher quality than the cement it replaces, allowing for higher strength or a reduced raw material cost. Mixing biochar to make organic fertilizer, CO2 to X, CO2 to Fizzly drinks. Using technology to recover metals from waste stream. Using technology to break down contaminated sewage sludge. From DAC, we see teams moving to point source solutions. And some of these trajectories take teams away from CDR proper, still pulling in the same direction, but then working above the zero line and not below the zero line. And this might be temporarily until the CDR market opportunity becomes more attractive, but this might also take them away more permanently. So from an investment perspective, CDR is not yet mature, and investors apply sound and careful judgment around the potential it offers. They apply reasoning from other more regular business-to-business verticals when looking at opportunities. And one quote comes to mind: the products and services that we want to support should simply be better than existing ones. That's totally classic. This is in itself not a problem. But if we want this market to evolve faster because we are dealing with a commons problem, and I think that is what we want, then public partners need to play a very active role in creating markets. That is it for me for now. Thank you, Caterina.
Thanks, Hans. And with that, we'll hand over to Chris for his contribution.
Fantastic. Thank you ever so much, and really appreciate joining the call today. I'll keep my remarks reasonably brief so that we can get into a discussion. So by way of introduction, I'm Chief Executive Progressive Energy. We started our first CCS project in 1998. We've been through a series of UK government competitions to establish CCS infrastructure. And in 2016, we conceived and started the HyNet Industrial Decarbonisation Cluster, which, very good news, 2 weeks ago, E&I, our consortium partner delivering the CO2 transport and storage, reached financial close for their project. And to put that into context, that was about 2.5 billion of funding that was required with a consortium of a large number of banks. What does that tell us? That tells us that the business model to put that infrastructure in place in the UK is financeable. So in terms of GGRs, where are the risks and where are the issues? And I guess we've spent a reasonable amount of time today looking at the market risk in terms of, you know, the product that is being sold, the stored CO2, the removed CO2 from the atmosphere. Two other areas are the infrastructure, and I'm unashamedly focusing on engineered GGRs here that rely on CO2 transport and storage, because I believe that's where the big volumes will be able to come from, certainly in the shorter term, as well as then the technology risk. So let me focus on that infrastructure one. Fundamentally, the fossil sector, the reductions sector, should do the heavy lifting on that CO2 infrastructure. They are dealing with millions of tons of CO2 that needs abating, and that will get the scale and size and therefore the cost down. And in reality, the scales we are dealing with GGRs tend to be smaller. So let's let the fossil infrastructure do the heavy lifting. The key issue, though, is how do you handle cross-chain risk? If I am a DAC plant, or I am a BEC plant, or a waste to CCS project, I don't understand subsurface geology. I can't make an investment decision based on my assessment of the risk of a particular geological formation to store the CO2 that I've sent away from my factory gate. And that is something that the UK government has done well. It has recognised that in the CCS sector, it needs to break the chain. So my CO2 infrastructure provider knows even if the CO2 doesn't arrive from an emitter, it will still be made whole through its regulatory structure. If I am an emitter who has captured my CO2 and it is within specification and ready to go down that pipeline, but my transport and storage provider can't take it, I am still kept whole against my business model. And that is absolutely fundamental. So that makes an enormous difference. And again, in terms of the structure of the business model, that if we take the conventional reduction sector, if I have an industrial carbon capture business model, that is structured so that I ought to be able to get my capital back in 5 years. So Mark, looking back at your paybacks and returns, that's tallied with that. But I have a 10-year contract over which I can actually, if I don't quite make it, I can extend that capital repayment, but I also know my operational costs are covered over that 10-year period. It is structured as a contract for difference against the value of CO2 in the market, and the 10-year basis is on the basis that by the time we get another decade forward, those emitters ought to be able to simply, the cost of emitting carbon should then be, or the paying that cost will be greater than it would have been if you actually captured, transported and stored it. So that's the basis for that sector. How does that translate for the GGR sector? The UK government is putting in business models in order to do that, and recognises that there is a role for the voluntary carbon market in reducing the level of subsidy that is required. But just in the same way as we see with our offshore wind, it is not just about the subsidy that is there, but it's the revenue stabilisation. And that is the thing with the voluntary markets that people find very difficult to do. So I guess as I finally wrap up, where do I think this will really hit the road fast? And I think that is energy from waste plants. If you look at the 7th carbon budget, take a look at it, look at the role of GGRs in the rest of this decade and into the beginning of 2030s, it is waste to energy plants capturing CO2 that are going to do the heavy lifting. Because if I have an energy from waste plant, about 50% of the material going into that plant is biogenic, 50% fossil, but that biogenic component, if I am storing that permanently, that is formerly things that grew, they had a life, They went in, couldn't be recycled. They went into an EFW, and that CO2 is permanently stored. So coming back to HyNet, even within the first part of HyNet, we are getting on for 1 million tons of GGRs, CDRs that will come through HyNet. We have the UK's largest energy from waste plant at Viridor, Runcorn facility, 1 million tons of waste, 1 million tons of CO2. Of that, 500,000 tons is biogenic. We have another new build energy from waste plant that's also in the region. So there'll be another couple of 100,000 tons of biogenic CO2. And there are other waste plants wanting to connect. In our first phase, we have a cement plant, of which around 1/3 of those emissions are associated with the fuel that's used in the cement plant. And nowadays, cement plants tend to use a reasonably high level of biogenic material going in there, so achieving the same thing. But then when we look at the Track 1 expansion for HyNet, there is a raft of more conventional GGR technologies looking to connect as well. Sorry, conventional as in what we tend to think of when we think of GGRs. So there are some small BECCS plants that will be looking to connect if they get awarded. And similarly, there are some DAC plants looking to do the same. But that reinforces my point. There's a piece of infrastructure that will take 5 million tons away in its first phase. About 1 million maybe DACs, of which the vast majority will be EFW, will be cement, those large scale, but then there'll be the 50, 100,000 tons coming in from other sources. So I am really optimistic we can do this. If we break that chain, we get the risk allocation right, and we put the revenue stabilization in there for the business models that allow the private sectors to invest. Yes, where is the last piece of risk? It's the technology risk for the capture plants. But actually, I think if you manage the market risk, you manage the cross-chain risk, actually, I suspect that we will find the markets will be happy to handle their own technology risk, that they can prove and scale up and do things like that if those other two risk allocations are properly dealt with. So there we go, my comments for now, and I look forward to the Q&A.
Great. Thanks all, and thanks to those that have already been posted some questions. Please do, we won't have much time, but if you have a question, please do post it ASAP. I know that Mark has already answered a couple of the questions. I'm keen to pose those to the other panelists as well, but in the meantime, I know, Mark, you wanted to comment on the question around the sensitivity of results to future costs of capital and operating costs. Can I bring you in on that question, and then I will ask the others to comment on the two other questions around investability of GGR based on other co-products and on the role of VCM. Mark, over to you.
Yeah, so thank you, Caterina. So anonymous attendee, essentially we did do sensitivity analysis, or rather Eduardo did sensitivity analysis around both CapEx and OpEx. It was integral to the robustness analysis, and it naturally had an impact. And one would, we can unpack and get that data to you if you're interested in it. I think you have my email at the back end of the slide deck, which may or may not be circulated after this. But in essence, the higher CapEx and OpEx possible futures simply just had an impact on the ability for it to cross those internal rates of return thresholds. And we can actually quantify the number of futures that had an impact on, and I'm more than happy to unpack the analysis to allow that to be better quantified if needs be.
Great, thank you. So going to the questions around co-product revenue streams, I was wondering whether Aoife, you can comment on that, and I'll come to you, Hans and Chris.
Yeah, I'll get us started, and then yeah, it would be great to hear more from Hans, and particularly building on some of the comments that he made earlier, because I think that's what we see a lot of startups doing, right? They're diversifying their business models. They're realizing that because of the market risk that we've talked about and the inability to be able to show now to investors that there are stable forms of revenue, there are alternatives, right, to bring in some of the examples that that Hans already mentioned, and that's possible with many different GGR or CDR technologies, whichever acronym we use, and I think that's a very classic way for firms to be able to manage the uncertainty that they're facing, and we see that as a very I think, you know, the key question, and I think I would come back to this, Hans, you mentioned it, it's unclear as to whether this is going to be temporary or not. Is it going to take the startups in a direction that will compromise some of the goals that we're trying to achieve? And I think that's a big question for research to be focused on in the coming years. And what are the implications of some of these diversifications of business models for addressing not just the economic value question, but also the environmental and the social, because there are some co-product revenue streams that make sense for to show to investors, but not necessarily in terms of addressing our removal goals. And that's something that Mark kind of touched on as well a little bit in his presentation. But I'm curious to hear more from Hans and Chris on this too, because I think it's a really key issue for us to be focused on and to be thinking about policy interventions creatively about or for.
Thanks, Aoife. Hans, do you want to come in on that point? And if you also want to pick up the questions around the role of VCM over to you.
Sure, yeah, I can take them both together. Indeed, we see startups diversifying, and we should also look at this from the perspective of time and scale. For an investor, that might be different than for a startup, right? I would say, although we haven't formally interviewed them on this point, but I would say startups might be more optimistic about future market developments than investors. Investors tend to be cautious and take into account what is the reality now, because 2-3 years delay of a policy instrument might completely kill their financials. So they don't bank on that. Startups in general, I would say, have maybe a more optimistic outlook, where they would say, well, in this coming decade, regulations will come into place that will support our businesses. And given that they are usually in CDR still at a small scale, they can diversify business models and revenue streams, build out their technology, bring their costs down, in order to what we call survive those coming years until this market really functions better. It's also necessary, and that links a little bit to the VCM. I would say the VCM is important and also not, in the sense that if you look at the volume of buyers that buy more than 1,000 tons, that's less than 100. Right, so that is just not a volume that you can build a business on. I mean, Microsoft and Frontier, it is all truly, and it's truly wonderful. But what if they don't buy from you, right? So you can't bank on it. There's almost a list of potential buyers in Excel that I can hand out to every CDR startup. So that doesn't work, because those buyers say, hey, I get 500 inquiries every month, so I can't deal with that, right? So that does not work in that sense. And I see that the VCM currently, what I call those trailblazers, they really do this for a mission to build this market, support building this market, pay relatively high prices. But it's also a catch-22, because if we want this market to scale, we need growth. And if we get growth, we will need to see lower prices, right? So you need more buyers, more volumes in order for teams to scale. And again, this is a reason for teams to diversify their business models. And I see it, the trailblazers in the voluntary market more, even if they do use it for offset claims, more as taking a contribution claim mentality in helping to build this market in the coming years. Over time, it's my personal conviction that we need policy regulations in place if we need to get to the volumes that we all know that we need to achieve. And without it, it won't succeed.
Great, thanks, Scott. And yeah, Chris, over to you.
Great, thanks. Yeah, so interesting question on co-products or co-benefits. I gave the example of energy from waste. What is an energy from waste plant selling? What is it doing? It's providing a public service in handling our waste. You know, you look at what's happening in Birmingham at the moment. If you don't remove people's waste, that has a profound impact on society. That is what they're doing. So actually, it's a really good combination with GGRs. It's particularly good because if I've got an energy from waste plant, that runs 24/7. That means I'm using that asset, that carbon capture asset, to run 24/7 and keep taking biogenic CO2 out of the system and sequestering it. So I think that's a really good example. Part of the reason why that's now happening is because we've got energy from waste is going to come into the ETS, and it wasn't in the ETS, or it hasn't been to date. But also, it's interesting, this is just an industrial carbon capture business model. It's not a GGR business model, but they've just put an extra handle in there that basically says, if you can get some value out of the VCM voluntary carbon market, then there is a way of reduce that comes in as a revenue stream, which therefore reduces the subsidy to government or to the taxpayer or the energy consumer. So that's interesting. If I take BECCS, it is really interesting because arguably that's providing a co-product, but you might find you're diverging in what you're trying to do with that co-product. BECCS is going to support the electricity system to make it reliable, but it's going to make it reliable when the wind isn't blowing, the sun isn't shining, and filling in those gaps. So the market for the electricity is going to be a varying market. But once I've built that capture plant as a GGR technology, I want to run it 24/7 and keep going. So you actually end up with a slight divergence as to what is the primary purpose of this plant. Is it primarily GGR, or is it primarily giving resilience to the electricity market? So you have to be careful when you've got co-products, because you might find that the Venn diagram of when they're both working is not exactly where you want it. A couple of other thoughts on the other side of things. Look, yeah, I think biochar and some of the non-engineered GGR relying on CO2 infrastructure, I agree. I think you are looking to say, what can this do for soil remediation? What can this do for water content? What can this do in terms of nutrients, as well as the GGR one? So that's good. And finally, on DAX, which is interesting. I mean, with DAX, you're basically turning electricity into stored atmospheric carbon. Therefore, electricity is absolutely key, and it could happen anywhere in the world. And the question is, shouldn't you just do it where your low carbon renewable electricity is both cheap and abundant, as long as you've got somewhere to store it? That may not necessarily be the UK at scale.
Great. Thanks all. We are coming up towards the end of the session. Before we wrap up, I'm going to ask the four speakers if you can give 60, potentially even 30 seconds, one final message which you want the audience to take away from this discussion. I will go in the reverse order. So we'll start with Chris, then Hans, then Mark, and Aoife to conclude it.
Look, we can do this. By 2030, we're going to be storing at least 500,000 and making our way to 1 million tons of CDRs here in the UK. If we get the infrastructure right, if we get the policy right, we get a platform and we can make it happen.
Tagging on to what Chris also earlier said, if we look at atmospheric CO2 as a waste product, it's a waste product that's not localized, it's dispersed. It's a perfect example of a commons. That's not a perfect playground for investors, and it's a perfect reason for why we have governments. In order to be catalytic, a rule maker and a creator of markets. And if governments take up that role, when we have those markets, private capital come in, and to second what Chris said, then we can do this.
Mark, over to you.
I'd echo Hans's point. The role of government, and the UK government has done more than most, so we can't underestimate what they've done. I mean, Chris's project is evidence of that, and success, inadvertent or otherwise, is testament to the risks that the UK government's taken. But until such time as we can address private sector risk, start pricing private capital and act as a backstop to provide market confidence that the 13 missing years that the offshore wind sector had, that we're not going to have in this space, it's going to be very hard to get private sector actors to intervene, to provide private capital.
Brilliant. So the takeaway for me personally, and I think from our work, is that there's just so much potential, there's so much creativity, and in order to be able to leverage all of that, we need to have we need to be thinking a bit differently about the role for the public sector in different countries. And as Mark has said, the UK has been at the forefront of this. I think we need to keep going with collaborative approaches, with breaking down silos, with making sure that we're integrating lots of diverse knowledge, because there's just so much complexity and uncertainty in this new industry. And yeah, we have the tools at our fingertips.
Great. And with that, we've come to the end of the session. I would like to thank the speakers for their insights. Thank you all for attending and for your questions. I should mention that a recording of the event will be made available on the core website in case you want to look back at the presentation or the discussion. I should also mention that the next webinar will take place on Wednesday, 18th of June at the same time, and we'll be discussing a taxonomy of policies for greenhouse gas removals. We'll be sending a registration email with registration details in a follow-up communication. Thanks again for joining us and have a nice day.